Welcome to Opal STV. Today I'm in London, together with Mark de Klerk. He's the head of seeding for Advantageous Capital. Advantageous is one of the most active seeders in Europe, and the company is active in seeding both offshore hedge funds as well as alternative UCITS. Mark, tell us more about your background and also introduce your company to us.
I'm a day one partner with Advantageous Capital. Founded Advantageous in 2011 with the objective of building an independent European alternative asset management business. Part of a 13-strong investment team, and I'm the portfolio manager on Advantageous Emerging Opportunities, which is our dedicated offshore seeding vehicle. Part of the original founding investment team came out of Credit Suisse, the multi-manager business based here in London, including Salvatore Codaro, our CIO, and myself. In respect of Advantageous, we have a banking arm in Italy, and we also then have an asset management arm focused on alternatives, and that's where the seeding focus is. We've got group assets of around 17 billion, of which around 2.3 billion is focused in the asset management side of the business. On the asset management side, we manage both multi-manager products focused on bespoke and commingled solutions for our clients. We also have single fund offering in the UCITS space. We have 5 managers currently on our platform, all managed by external managers. We also have capabilities in the alternative risk premium space and also in the renewable energy space. We have around 150 people within the group, of which approximately 50 people are focused on the alternative side, and that's split across London, Milan and Rome, servicing our large institutional client base. To give you an idea, around 65% of our client base comes from insurance companies, and the rest is made up of sovereign wealth, pension funds, large family offices.
Can you give us more background about your seeding activities?
We've been focused on emerging managers since the inception of Advantageous. We're one of the most active European-based seed investors today. We've invested approximately $700 million across both offshore and UCITS funds, approximately 15 transactions over the last 4 years. Today we manage 2 products, around $400 million in AUM, focused one on offshore seeding and the other one on UCITS seeding. In the offshore space, we typically look to invest seed capital or acceleration capital of between $50 and $100 million in total, typically looking for a gross revenue share interest of between 20 and 25%, typically for a fixed term, sometimes a perpetual element. And in the UCITS space, our ticket sizes are a little smaller, around 25 to 30 million euros.
I believe you're in the process of raising capital for a second vintage of your offshore seeding program. Can you tell us what attracts your investors to your seeding activity?
You know, we're seeing interest from 2 different main investor bases. One is the traditional hedge fund allocator universe, and the other is actually on the traditional private equity side. The traditional hedge fund allocators are looking to enhance returns in a low yield environment by effectively investing early stage with emerging managers and receiving an interest in their business in what is still a very high margin industry at no additional cost. They're attracted to the positive convexity that seeding can provide to their portfolio, because if you think about it, the revenue share participation can never be negative. So these investors are able to target returns of 12 to 15% net IRR compared to their typical diversified portfolio of hedge funds, where they're targeting more like 5% annualized return in a fairly low volatility portfolio. Of course, they need patient capital to do this, but many of these investors are actually investing for the longer term with these managers anyway, so it makes a lot of sense for them. On the private equity side of the equation, we're seeing private equity allocators who are quite interested in the diversification element that this brings to their book. Investors are attracted to the high margins within this industry. They quite like the natural exit because you can redeem your fund investment after the lockup period. There are all sorts of contractual protections that are baked into a seeding agreement, and we're targeting a return profile which is quite similar to what they're being offered via the private equity industry, but with a very much lower duration and arguably at a very different point in the cycle. First and foremost, we're trying to find good investment opportunities. We are part of a much broader multi-manager business, and we are trying to source managers who are good early stage emerging manager investments. You know, some dedicated seeding investors put forward a competitive advantage being that they are specialized and focused only on seeding. We take a slightly different view on that. We'd rather be part of a broader capability, and we believe that that's given us access to some transactions that we probably couldn't have done if we were a smaller entity. Secondly, we spend a huge amount of time upfront before we even make a proposal to the manager. We want to understand their business, we want to understand their objectives. We try to spend a lot of time structuring a transaction to maximize the probability of success, not just for us, but also for the managers. And we don't take a one-size-fits-all approach. We try to leverage off of what we believe is a world-class due diligence capability. We're effectively providing free advice and consulting to underlying managers. So spending a lot of time, in some cases, sourcing COOs for managers or introducing independent directors. Spend a lot of time on things like fund governance, on the operating infrastructure. We work with managers as well on more strategic activities around what their business plan is, how they're going to grow the business, what the marketing plan is, that sort of value add. We basically want to get into a position where if we as Targus are comfortable making an allocation to a manager, then hopefully other institutional allocators will also be comfortable.
The hedge fund industry has actually had a few rough years, both in terms of performance and in terms of flow. So I wonder, how does this affect the opportunities in seeding right now?
Hedge fund returns have been very challenging in an era of central bank intervention, low volatility, very high intra-sector and cross-asset class correlations. Actually, what we've seen is that seeding has provided a very nice enhancement to returns in that environment. But you know, in our view, many of those headwinds are dissipating, and we actually think the environment on a forward-looking basis for the next 5 years is much more attractive than the environment over the past 5 years, especially in a market where valuations are looking top end in both equities, fixed income and credit. Also, the current supply and demand dynamics in the hedge fund industry we think is very favorable for seeding.
And why is this?
You know, I think there are a couple of reasons. Pre-2008, it was the fund of funds who really had the resources and the risk appetite to be in the seeding business. Post-2008, fund of funds decreased in both number as well as assets under management and were to an extent replaced by the consultants who were responding to a institutionalization of the investor base within the industry. The consultant business tends to be a fairly conservative business model and focus on economies of scale. So consultants don't tend to recommend that their investors go into emerging managers. They typically have minimum track records, minimum AUM sizes. What we also saw was a move away from the banks who were no longer seeding teams either internally or externally due to Volcker rule under Dodd-Frank. And then finally, we saw some of the large traditional seeders move into more of that scalable private equity business of taking minority equity stakes in established managers, a very different business model. And so what all this has resulted in is a bifurcation of the industry over the last 10 years where really most of the flows have gone into the larger managers. And we are left in a situation where there are some seed investors like Targus, but otherwise it's family offices, some pension funds, some endowments who are very opportunistically making seed investments, but not on a systematic basis. And we're also seeing some of the larger established managers who are seeding the second generation spin-outs from their businesses. But otherwise, the supply of capital is very limited, and we think that provides great opportunities for guys like us who are systematically making these investments.
So what's the current demand for seeding like right now?
The demand for seed capital is actually very high. Even quality managers are finding it's much more expensive to launch funds. The access and the barriers to entry have increased significantly, and there's much more of a regulatory burden on launching a fund these days. What we are seeing, though, is probably more second and third generation asset management spin-outs these days, rather than the prop desk spin-outs from 5-6 years ago. And these managers tend to be a little bit more aware of how difficult it is to manage an asset management business, and tend to probably value the seed capital and what a group like Hedge can bring to their business.
But at the same time, isn't the industry maturing with the compression of fees and the decline in growth rates? Now, isn't that also a headwind to seeding?
You know, we definitely expect continued downward pressure on fees, but I've actually been quite surprised at exactly how resilient fees have been over the past 10 years. But probably more importantly is that it's also still a very high margin business. So once a manager gets to a certain scale of assets under management, margins are in the region of 40 to 60%. On the other hand, asset growth has definitely been more challenged, and the industry is maturing. However, some of the numbers that are coming out on allocations into emerging managers have actually been quite positive. So after a number of years of continued flows and allocations going to only the larger and established managers, we're now seeing allocators looking much more seriously again at the emerging managers, probably as a result of some disappointing returns amongst the larger managers. Most of the surveys are quite consistent, but there's one particular industry survey which showed that there was around 10 billion of asset flows into emerging managers, defined as being less than $1 billion last year. And that was in the context of broader outflows from the industry. What is interesting is that their numbers up until the end of May this year show inflows into emerging managers less than 1 billion of around 16 billion. What might be more interesting, though, is that actually more than 14 billion of that was into managers who were between 100 and 500 million in AUM. So we think that actually there's some good tailwinds to asset raising coming up for emerging managers, and therefore hopefully for seeding.
Some of the traditional seed investors have now gone into the model of taking equity stakes in managers. I wonder, are you doing that? And also, how do you see the risks and the opportunities in that sector?
We don't take minority equity stakes in established managers. We focused solely on seeding and acceleration of emerging managers and receiving our stakes at no additional cost to the fund investment. But it is interesting because we do speak to some investors about seeding, and sometimes they talk about being in seeding, but actually they're in that, what we view as being quite a different business model with different risks and different return profile. We like the fact in the seeding and acceleration space that you have a natural exit, effectively the redemption of your capital, which you don't get in that equity stakes business. Effectively, our duration is far less, and in that side of the business you need to IPO or you need to sell a stake in order to actually get your capital back. Also, we like the fact that you can negotiate all sorts of contractual downside protections as a seed investor. A little bit counterintuitively, when you're looking to take an equity stake in an established manager, you may be in a slightly less favorable negotiating position because you're negotiating with an established manager. However, it's true that you will get a higher distribution effectively on the equity stake side of the business from day one. I would argue that possibly that is not just a return of yield, but also a return of capital. Operating leverage works in both directions, right? So in that business, when a manager starts to lose assets or shuts down, you're at risk for your entire capital. I think what it comes down to is the manager that you are involved with, and I suspect that different models will work at different points in the cycle. But in this point of the cycle, we're quite happy to be focused on seeding and acceleration.
So I wonder, could this private equity model then be an opportunity for you in the seeding space?
Potentially. I've actually had a thesis for some time which I think is starting to play out. There is a significant overhang of capital in that space. If you do a back of the envelope calculation and you think about many of those allocators are typically looking for 5 billion plus in AUM, multi-PM type investment manager, there aren't really enough managers who are looking to exit or sell a minority stake in their business to satisfy that demand. And capital is being continued to be raised into that space. So I have a thesis of one of three things is going to happen. Either capital is going to be returned, or returns are going to be compressed because you're going to see price competition in that space, and we're already seeing that. Or thirdly, I think you're going to see those type of investors coming down the AUM scale and looking at smaller managers. And that, of course, is where we have an opportunity potentially to exit some of our seeding positions, because we always have a right to participate in a sale event as part of our contract.
So no doubt you're looking at many candidates to potentially seed each year. What are you looking for? What are your criteria?
There are hundreds of factors that go into an assessment, and we're looking at many hundreds of managers each year. And to give you a sense, we are looking to seed maybe 2 to 4 managers a year. So it's quite a selective process. First and foremost, we're looking for good investors. We're looking for investments that we would want to make, irrespective of the seeding aspect. I mentioned before, we're very focused on emerging managers, and so we're always on the lookout for good managers. Ideally, the manager comes with some sort of track record that we can point to and verify. Not essential, but we're not in the business of seeding ideas. We're not a venture capitalist. Ideally, there is a setup where you've got a very clear CIO. Even if there are multiple PMs, we want to know that one CIO is running the show. It's important that the manager is able to clearly articulate both what their investment edge is, what their investment process is, and also how they differentiate to all the many peers that may be out there that we could be looking at. It's also very important that we trust a manager. We want to invest with managers with a high degree of ethics and that we respect and can work with over time. Ideally, that's in a framework where there's a team that's worked together for some period of time. And then the other aspect is that we want to have a high level of alignment with our managers. So we expect our managers to be able to make a significant investment in their own fund. That can be both a signal as to their level of success previously, and also a good alignment of interest for us as an investor. We also want to be in a position where a manager isn't stretched too much from a financial perspective if the fees that we're paying and potentially with other investors on day one aren't sufficient to cover the working capital aspect. It sort of goes without saying that we're looking for a robust risk management, both culture and infrastructure, and the same goes on the compliance side. But what we're really looking for ultimately is managers who want to build a long-term sustainable business. Managers can be excellent traders, excellent portfolio managers, but if they don't recognize that they need to be able to hire the best talent possible in order to build a longer-term sustainable business, then probably we're not going to have success with them. The other aspect that we're looking for is scalability. So typically we're looking for around a 15 times level of asset base versus the commitment that we make to a manager.
So Mark, you and your team, you're in a quite strategic position when you're providing seeding or acceleration capital to a hedge fund manager. I wonder, what other benefits can you negotiate?
Yes, we do negotiate a number of additional benefits. Probably the most interesting for our clients is the low fees and capacity that we negotiate with our managers up front, and that can benefit both our seeding allocators as well as our broader discretionary portfolios.
Are you focused on any particular strategies?
We invest across strategies, and we take into account our quarterly strategic review when we are sourcing managers, but none of us here has a crystal ball and can tell you which strategy is going to be performing well in 2 to 3 years' time, or for that matter, raising assets. So we try to construct a balanced portfolio, firstly by strategy, but probably more importantly by underlying risk factors.
Mark, what about managing the downside risk? You're providing lock-up capital, so isn't this inherently more risky than investing on standard terms?
You know, intuitively, it may seem like this could be more risky, but we are in a very strategic position as a seed investor with an ability to influence all aspects of the business, including what the business and the fund structure looks like, including things like fund and business governance. We are also, as a seed investor, spending a lot more time with these managers, both before and after investment, than your typical standard investor. But irrespective, these relationships are governed by a 70 to 80 page heavily negotiated contract, which cover all sorts of protections for the seed investor, including information rights, consent rights, redemption triggers. What we're really trying to achieve and think about upfront is what are the things that would make us uncomfortable or would be outside our range of expectation if we were invested as a standard investor. And because we're locked up, we try and incorporate those factors into the contractual agreement as downside protection for our investors.
And finally, what does your pipeline currently look like?
At any point in time, we have probably around 8 to 10 conversations that could turn out to be real seeding discussions. But at any one moment, I would say we have 1 to 2 transactions that are live. We think the pipeline is looking very good at the moment. I'll give you an idea. We currently have 2 live transactions. One is a London-based long-short equity manager who is focused on the healthcare space. Comes out of a number of very large hedge funds in his past, has a great pedigree, and we're very excited about that opportunity. On the other hand, we are also live with a Hong Kong-based global macro manager who is focused on the Asian space, again with a very good pedigree. Maybe what's quite interesting though is that we've agreed terms with a fixed income relative value manager who's launching in New York, focused on a fund launch in the liquid rate space. We've been invested with this manager previously, and what's quite interesting about the transaction is the agreement is that he needs to raise $150 million worth of day one capital in order to launch the fund. That illustrates, number one, where we can add value as an anchor investor in order for him to raise that capital, but I think is also a demonstration of the quality of the opportunity set that's available in seeding today.